Are your family legacy assets suitable for your retirement plan? Well, here to talk with us about that is Robert Klein, the president of the Retirement Income Center. Robert, welcome.
Thank you, Bob.
So we're eager to have this question answered.
Yeah, it's something I've thought of from time to time as I've had different clients over the years inherit assets, and most people are familiar, obviously, with inheriting assets, but this is kind of a subdivision, if you will, of inherited assets, family legacy assets, which are a particular type of asset. There are assets that have either been formally or informally designated by the original owner or, in the alternative, assumed by beneficiaries as assets that are to be kept in the family indefinitely.
And there are different types of these assets?
Yes, you have generally what people are mostly familiar with in terms of family legacy assets are things like closely held businesses and real estate, but they can include really anything: bank accounts, non retirement and retirement investment accounts, personal property, and intangible assets.
And obviously, you talk about in the article that you wrote for Retirement Daily that these tax planning strategies for preserving these assets have been the focus of the financial side of the family legacy planning, and that there are strategies designed to maintain control over these assets and how they're distributed.
Yeah, and sometimes the owner discusses the strategies with the family a lot of time sometimes, and with the bigger assets such as closely held businesses and, let's say, commercial real estate, it's quite common for the original owners to memorialize their wishes that these assets be maintained in the family in their estate planning documents. Other times, just from time to time, a person will discuss the importance of keeping a particular asset in the family with various family members. And this is often motivated by a sentimental attachment to a particular asset, whether it be a stock of a company that the individual worked for or a particular painting. And then oftentimes, beneficiaries assume that a certain asset is, in fact, a family legacy asset for various reasons. However, I found sometimes when a beneficiary will assume a particular asset is a family legacy asset, it may not be. It just might be a situation where the owner didn't want to sell the asset during his or her lifetime due to a potential sizable tax liability.
Right. And how do you go about identifying the suitability of these assets for your retirement plan?
That's a great question. And suitability, when you inherit family legacy assets, most people don't give it thought as to, okay, is this a good asset for me? My father or grandfather was, thought that this is an asset that should stay in the family. But the reality is, you've inherited the asset and you may not have the personality or inclination to manage a particular asset. So it's important to do a suitability analysis, and that should really be done by your financial advisor in conjunction with a CPA, somebody who specializes in taxation. And if you don't have a retirement plan, it's a good time to think about doing a retirement plan when you inherit a family legacy asset because there's a lot of moving parts to it. But the point is, suitability analysis is a very important thing that should be done in conjunction with the inheritance of a family legacy asset.
Right. And you put in place in the article numerous factors to consider when evaluating an inherited FLA. Are there a couple, three that are worth mentioning?
Yeah. First and foremost, perhaps, is to look at what retirement planning stage are you in? Are you still in the accumulation stage or retirement income stage where you need a particular asset for retirement income? Because that'll give you a sense of whether this is an appropriate asset for you. Other things you to consider are the length of time that you plan on keeping the asset. Would you have purchased the asset if you didn't inherit it? Something else that often happens is you may not inherit 100% of the asset. It might be a co-ownership situation with perhaps other family members have inherited portions of it, and you have to think about things about family interaction issues. Do you work well with the family members? How's this going to work out? And then another important consideration is looking at the net after-tax proceeds from selling the asset.
Talk more about that.
Yeah. So a lot of people, because of their attachment to family legacy assets, they either don't consider what the tax consequences would be or minimize the importance if the asset was simply sold. And with something like real estate, where I mentioned earlier that an owner might not have sold a particular asset during his or her lifetime because there'd be a sizable tax liability associated with that. The opposite occurs when a person passes away. To the extent you inherit that asset, there is what's called a step up in basis, whereby the original cost basis, the original purchase price or cost basis is adjusted to what the current fair market value is on the date of the decedent's death. And by doing that, by adjusting the cost basis up to the fair market value, assuming there's been appreciation, that provides you with an opportunity to sell the asset with little or no tax liability. As a matter of fact, in community property states like California, there can be a double step up in basis, so you can literally pay no tax on the sale of that asset. So that's a really important thing to look at anytime you inherit a family family legacy asset, rather, to see what the tax liability would be simply if you sold the asset, and then that can make the asset obviously liquid, and you can do other things with it.
Right. So one way to make this real for people is to give them a case study.
Yeah, I put together a case study here where I looked at a situation where you have inherit a family legacy asset. In this case, it was a vacation home that was owned originally by the individual's grandparents, and it was in particular, I just chose the Jersey Shore, that this was a beach home at the Jersey Shore, and the family members, there were different family members over 60 years that enjoyed get-togethers during the summer at this home. And so the grandson that inherited the asset had to make a decision, and obviously there's emotion tied into this because him, as well as his wife and kids, enjoyed many summers at this home and didn't want to give it up because that meant the end of a legacy, if you will, as far as enjoyment of the experiences that they had. So, but the reality was, in this particular case study, that while the grandson had him and his wife had a significant amount of guaranteed income from annuity, Social Security, a pension, and the wife had recently inherited an IRA, which was a large IRA. And so they took minimum distributions from that were pretty sizable. So between the minimum distributions from the beneficiary IRA together with the guaranteed income, they did a good job of covering their expenses. The main concern, besides inflation as it affects expenses, were the expenses associated with the vacation home itself, which were sizable. And I intentionally chose New Jersey because I'm familiar with the real estate taxes there. They're not cheap. And so basically, even with an $800,000 home there, the real estate taxes alone could be 4% or 32,000, and between that and other maintenance expenses, it would have been challenging, to say the least, to maintain the home, and especially it's a home at the shore, which required a lot of upkeep and maintenance. And so, an obvious question is, well, why not just rent it out? But the reality was, in this case, that the family members spent their summers there, so you wouldn't rent it out during the summer. And the fact that it was at the Jersey Shore, it wasn't necessarily amenable to a good rental situation the rest of the year. So the bottom line here, Bob, was that the family, did a reality check, and despite the emotional attachment, they made the decision to sell the home. And because they could take advantage of the step up in basis that we just talked about, they didn't have to pay any taxes, and this would enable them going forward to cover their expenses, even inflated expenses, and also use the lump sum towards long-term care events should that arise, which is important in their particular situation because they didn't have or qualify for long-term care insurance.
Mm. It's so interesting, Robert, because this topic affects so many people, and I think no one thinks about it until it happens, and then they have to think about, well, now what do I do with this painting, with this beach house, with this ski house, or whatever the asset might be. So I really appreciate you walking us through what is oftentimes an overlooked topic. Is there anything we missed or anything that bears reemphasizing?
The only other thing I mentioned at the beginning of the article, I didn't really get too much into closely held businesses, which are a common family legacy asset, because that would involve, I believe, a separate article on that topic alone, because there's so many variables with that, and liquidity issues and dynamics of family members to the extent that multiple individuals inherit the closely held business.
Yeah. Well, we'll save that topic for another video and article, I think, if you don't mind.
Yeah.
So in the meanwhile, as always, I want to thank you for sharing your knowledge and wisdom with our readers and viewers. It is, as you know, always greatly appreciated.
Thank you, Bob. I enjoy it. Thanks.